Welcome to The Explainer. So glad you're joining us today because we are about to unpack a stock with an incredibly fascinating, data-rich financial paradox. We're talking about Century Aluminum, ticker symbol CENX. My goal here is to translate complex data into clear insights. And let me tell you, the raw numbers for this company are going to challenge everything you think you know about traditional stock valuation.
Let's kick things off with a massive number, over 643%. That is the wild 3-year return for Century Aluminum stock. If you had held this stock over the last 36 months, you would have seen an absolute multiplication of your capital. But the central mystery we're solving today is how the underlying business numbers actually justify this explosion. Because as we're going to see, the fundamentals are sending some wildly mixed signals.
All right, here's our roadmap for today. We'll cover the Century Aluminum paradox, unpacking the wild returns, the earnings versus cash disconnect, making sense of valuations, financial health and margins, and our final metric review. We're going to systematically translate a dense wall of financial jargon into a crystal clear picture of this company's true health. Let's get to it.
Section 1. The Century Aluminum Paradox. The core conflict.
We have a staggeringly huge gap between the past and the expected future here. On one hand, investors are currently paying over 145 times the earnings the company actually made over the last 12 months. That trailing PE is massive. But looking ahead, the forward PE is sitting at an incredibly cheap 6.48. The market is basically betting that earnings are going to just absolutely skyrocket to justify the current price.
And because of this, standard financial models kind of just break down. If you run a traditional discounted cash flow model on this stock, it literally spits out NA for the fair value price and the margin of safety. The metrics are so wildly divergent and historically volatile that standard predictive algorithms just throw their hands in the air.
Section 2. Unpacking the wild returns. Let's look at the historical price action.
So the crucial thing to understand is that this stock definitely does not move in a straight line. It is a total roller coaster. It surged over 129% in 2017, only to crash by nearly 63% the very next year. Fast forward, it drops another 50% in 2022, but then just explodes by 115% in 2025 and 45% in 2026. This objectively proves that we're looking at extreme cyclical booms and bust, largely driven by underlying commodity markets.
But reality check time. Even with those massive recent highs and multi-100% single-year gains, the total 20-year return sits at just 20.05% total over 2 decades. That absolutely solidifies the narrative here. Century Aluminum is a story of extreme cyclicality. It's a trader's playground for timing booms and busts, not exactly your standard steady compounder. Section 3. The earnings versus cash disconnect. This is where things get really interesting. There is a staggering disconnect happening under the hood. Over the trailing 12 months, the net income compound annual growth rate plummeted by over 87%. Earnings momentum basically fell off a cliff. But trailing free cash flow growth, it is exploding by over 179%. The income statement is flashing red, but the cash register is literally overflowing.
To put that into actual dollars, the company reported $39.7 million in net income over the trailing 12 months. Yet, the actual free cash flow, the hard cash left over after operating and capital expenses, is $84.8 million. Free cash flow is more than double the reported net income right now. Cash is king, right? And that definitely helps explain why the stock might be surging despite those ugly earnings figures.
Moving on to Section 4, making sense of valuations. How do we price this thing?
I want to pause for a second and just pose this question directly to you. How exactly do you value a stock where trailing earnings growth has essentially evaporated? When earnings per share growth is down -95%, that standard PE ratio becomes almost useless, inflating to that absurd 145 we talked about earlier. We have to look at different tools.
And a great tool for this is the price to free cash flow, or PFCF ratio. This metric just measures the price of the stock relative to the actual free cash flow it generates per share. Since Century's cash flow is vastly outperforming its net income right now, this gives us a much more reliable indicator of what investors are actually paying for.
Right now, Century Aluminum's PFCF is sitting at $65.26, but context is everything here. That number is a 2,400% spike compared to its trailing 12-month average. So yeah, cash flow is booming, but the stock price surged so fast that the valuation has become incredibly high relative to that cash. You are paying a very steep premium right now for every dollar of cash the business is pumping out.
And we see a very similar story with the balance sheet. The current price-to-book ratio is 6.98. If we compare that to its 3-year average of 4.30, the stock is currently trading at a 62% premium to its own recent historical baseline. Basically, looking backward, Century Aluminum is priced for absolute perfection.
Section 5. Financial Health and Margins. Let's check the foundation.
Let's fire through these liquidity metrics, because honestly, they tell a pretty reassuring story. The current ratio is 1.97, so they have nearly twice as many short-term assets as liabilities. The quick ratio is essentially 1-to-1 at 0.98, and the debt-to-equity ratio is a very manageable 0.72, which is actually down from its 3-year average. So despite the crazy earnings roller coaster, the balance sheet is surprisingly stable and modestly leveraged.
On the profitability side, margins are pretty tight, which, to be fair, is completely typical for a basic materials company. Gross profit margin is at 9.55%, and net profit margin is 5.71%. But check this out. Return on invested capital, or ROIC, is 8.60%. That might not sound huge, but it's actually up 139% from its 3-year average. Management is getting much better returns on the cash they're putting back into the business.
Finally, Section 6, the final metric review. Let's pull this all together.
If we track the total return compound annual growth rate backward through time, a very clear pattern emerges. Over 10 years, it's 23.65%. Over 5 years, 28.53%. But then it jumps to 88.75% over 3 years and a whopping 214.34% over the trailing 12 months. This proves that almost all of that explosive, market-beating growth has been completely front-loaded into the most recent periods.
So bringing it all together, Century Aluminum is a fascinating puzzle. You've got surging recent returns mixed with a deeply cyclical history. There's this wild disconnect where trailing income is tanking while free cash flow is booming. And right now, it's sitting at a heavily premium valuation, but backed by a surprisingly stable, low-debt balance sheet.
Which leaves us with one big question. The market is clearly expecting a massive turnaround, pricing the forward PE at an incredibly cheap 6.48. But with 20 years of boom and bust data right there in the open, you have to ask yourself, does that forward expectation justify the inherent risk of such highly cyclical earnings? You've got the data, the metrics, and the context now. The next move is up to you. Thanks so much for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you next time.